Well, good morning, John. It's good to see you. We are recording this on Thursday, the 8th of May, just before the market opening. John, we haven't really spoken since the federal election of last weekend, where, as everyone knows, Labor scored a massive victory, and the market hasn't really reacted. I think it's more a case of continuation of the last 3 years for the next 3 years. The big three implications, I guess, would be on their superannuation policy, perhaps the HEX policy of the 20% write-off, and perhaps on housing. Is that how you see it? Do you see any big implications, and perhaps any changes, policy becoming a bit more perhaps aggressive in pushing their agenda, or do you think that they'll live up to their pre-election promises?
Well, they've got some sort of mandate, Paul. I mean, you can't deny that. And as I've said elsewhere in some videos, I'm sort of kicking myself because I did say 6 months ago that there would be a significant protest vote by younger generations, and as time passes, more and more younger people get a chance to vote, and older people pass out. I mean, it's and you can see that the electorate is very divided on ages. That's what I see. Now, we haven't got the final figures yet, and there'll be a lot of analysis done, but I think that's what it's going to show. And I think an indication of that is the postal vote, which is obviously older people, which is very much pro-Liberals, whereas on the day vote was very much pro-everyone else, more so Labor. So Labor's got the power in the lower house. They've got the power of government. I do think they made a lot of promises which they'll regret, because I actually don't think they believed they were going to get an outright majority, which they got. And so they were pulling out promises which, whilst they say they were, funded, or whatever word they use, well, funded by deficits, not funded by revenue. And the big issue they're going to have is collecting revenue, and that takes you into the superannuation policy, which I'll get to shortly. The housing policy, again, I think it's just pushing people into an overpriced housing market. That's the way of Australia. That's what Australian politicians want to do, both sides. There is no thought about making it truly affordable, which is to make the housing market a place where a young family can come in and aspire to own their house within 10 years, maybe 12 years. That dream, you might be living in a house, but you'll be having a mortgage for the next 20 or 30 years. So it's not affordable. So the promise of building more houses and tax or the 5% deposit and the government guaranteeing, okay, it's just more of the same. Back to super, which is obviously something which is going to come into focus because the government needs to raise revenue. And I do question the calculations, and it doesn't make sense to me how they're going to get $2.5 billion out of that tax. I think that won't happen. But if you reverse engineer, there seems to be an extraordinary amount of money with an extraordinary limited number of people sitting in super. And if you do back of the envelope estimates, it looks like there's close to $400 billion sitting with about 80,000 funds, which is an extraordinary amount of money. 10% of Australia's super sitting with some very, very wealthy families. And unfortunately, what the Labor Party's done is introduce a policy which is indiscriminate. Arguably people who have spent their life saving over the last 40 years are close to and may have $3 million, and they've paid their tax and their contributions and did it based on policy. And what they're being caught with is a type of reasonable benefit limit, which has come out of nowhere, the $3 million limit. But rather than saying that's the limit, which we think a pension should be at, the capital value of a pension, they haven't done that. They've said, no, we're going to bring in this outrageous tax on sums above that. And you go, why would you do that? And it's clearly an attack on the mega wealthy family offices of Australia. That's what it is. There hasn't been enough documentation, there hasn't been enough disclosure about who these people are and what sort of benefits they are collecting through the superannuation taxation system. On the other side of the ledger, and I don't want to bore people, is the defined benefit scheme. Now, all the problems started 20 years ago when we closed off defined benefits, which had to happen because they were unfunded, a massive liability for the taxpayer. And concurrent with that, the then Treasurer Costello opened the floodgates so that wealthy families could pile money into super and get tax breaks. So it wasn't savings along an employment line where people were employed and contributing to super. It was a transfer of massive amounts of capital out of a taxable position into a low tax regime. And that was sanctioned by the Liberal Party and Costello at the time. Now, there's been reversed and reversed and reversed over time. But what it did, it breached the standard view of what is a reasonable benefit inside super for a pension. And what we've got is an archaic debate which is not actually, focused on what the real issue is, that there's way too much money in super in Australia. There's way too much money with too few people in super in Australia. It's not dispersed properly, and the superannuation system of Australia is not fit for purpose. And unfortunately, a very small minority of people have turned it into a tax minimisation scheme.
Yeah.
Now, it hasn't happened last year, Paul. It didn't happen 2 years ago. It happened 20 odd years ago with, successive governments not being honest with the Australian people.
And it's creating all sorts of peculiar distortions. First of all, the big super funds investing in America and putting pressure on the Australian dollar, the following the index, pushing up the bank stocks and so on. There are all sorts of unintended consequences of having these trillions and trillions of dollars stuck in within super.
Yeah, and there's no thought process, Paul. $4 trillion sounds a lot. I guess it is, compared to the Australian economy, which is circa 2.8 trillion.
Yeah.
But it can't be invested in Australia. Now, that's not the end of the world if it can't be invested in Australia, but the world situation, when we raise capital and we deploy capital, you're trying to get a return on it, a fairly consistent return to compound over time and to meet liabilities as they occur as people move into retirement. That's the aim of the scheme. But it seems to have gone all over the place with this mad rush to raise as maximum amount of money as possible inside a super system. So raise the money first and then worry about how it can be invested second. I think it should have been the other way around. There should have been some thought process about what is the right size of a superannuation system? What's the right distribution of that capital inside super across the population? What's a reasonable benefit? Okay? They're the questions which were never answered in the construction of super in this country. And now we have a mess. And the mess in super, which is not as clear as the mess in housing and the mess in energy, but we have three big policy problems in Australia. Each are solvable, but they're not solvable by making piecemeal changes like we're seeing today.
John, let's turn to the US. This morning I was watching the press conference by Jay Powell. The FOMC has decided not to change their cash rate as expected. The US market has strongly recovered from the early April lows. A lot of the tariff talk is being walked back. China and the US are beginning formal negotiations about it. The mood seems to have lifted more onto a risk on rather than risk off strategy. Are you kind of confident that the market has put this whole tariff crisis behind us and we've seen the lows, or do you think this is more of a bear market bounce that we're experiencing? I know that's a hard question, but...
I don't think you can comment on bear market and bull markets. I think we've got to just look at the reality. And the Federal Reserve last night made it very clear that they're watching the tariff negotiations, and the longer it goes on for, their fear is higher inflation coming through imports, a slowing of the American economy causing unemployment. That's what their concern is, and they're saying, well, what do we do as a central bank when we're presented with a scenario where the government is deliberately inflicting pain on the economy to get what they perceive as a long-term result, which is bringing back manufacturing to America, becoming an export country and pushing down on the trade deficit, which hopefully in time will push down on the fiscal deficit. Now, I said last week, I think there's an underlying current to the American market. There is an animal spirit in the capital market of America, and it's the greatest animal spirit across the world. It's multiples of the animal spirit, the entrepreneurial spirit, which we see across Europe and other developed countries. So that's the big plus. But animal spirit is based on confidence. And I think we had a confidence shock with the tariff announcements and then the second and third leg with China, which were clearly unhinged, not thought about. And that caused a disturbance in the capital market and the entrepreneurial flair of America. Those who drive economic activity in America must have thought, well, crikey, that's totally unexpected. We can't plan for that. So they went on a short-term strike, equity market down, bond yields shoot up. There's the warning sign. Trump would have been advised, we're being too aggressive, we need to pull back. He also would have been advised that we have to give the capital market of America some confidence. And there's hints that the confidence will probably be a quantitative easing policy at some point, which is the printing of money and the buying of government bonds and the controlling of interest rates, independent of the inflation cycle. I would not have made that comment 20 years ago, but with the luxury of recent history, Paul, and QE programs across Europe and Japan and even North America and Australia, there's no doubt it's in the playbook. And I have no doubt that the capital markets, those who need to know, have been told, don't worry, we can fix every problem, and there will be problems, we can fix those problems by the American central bank printing money. The missing link, of course, is that the American administration, Trump, does not control the American central bank. So I've written a piece, which I've published on LinkedIn, I guess we'll do a link to it here, that we all have to watch the machinations between Trump and the Federal Reserve. I suspect, given the announcement this morning, there'll be another tirade from Trump. It'll be interesting. In one aspect, a tirade would not be unexpected. In another aspect, if he doesn't have a tirade, then he's being told not to have a tirade, because that would unsettle markets. So you can read into this, you can look at these things from different angles and try and work it out. We're dealing with an extraordinary situation in history. I do believe there is a plan, but I think, unfortunately, the implementation of the American plan is, ad hoc. It's unhinged. It's driven by the president, who's making unilateral decisions occasionally without advice, and is causing, repercussions when he makes those independent decisions. How much longer it can go on for, I don't know, but let's see how we go on the weekend with China and America.
Yeah, I just, I know that we've spoken about how important US Treasury rates are for the whole world. It's essentially the risk-free rate benchmark. And I looked at a one-year chart just this morning, and basically US Treasuries are trading around 428, 430. It's unchanged over a year, although it's had ups and downs. And that's without quantitative easing. So, obviously, Scott Bessent, the Secretary, is very focused on the 10-year bond rate. But even without them manipulating the Treasury rate, the bond market is behaving really, really well. Is that a sign that there is confidence that we'll manage to get through this muddle, or Is it a sign of the US economy descending into a mild recession?
All of that. I
Yeah,
just go back to my point. There's a massive animal spirits in the American
yeah,
capital market and business sector. Um, to some extent, that explains why they're so successful. They have an unrelenting target to deliver profit, and drive efficiencies. That has led them down a path where, in the pursuit of profit, it became obvious to capital owners, business entrepreneurs, that they didn't need to manufacture or build in America. That's why it was outsourced to Asia. Let's be very clear. America did what it's trying to fix with its eyes open. Okay, Trump can rant on about the unfairness of it all, but it was particularly beneficial to the American corporate sector to outsource. And the American economy, like Australia, has moved from some agricultural manufacturing base 30, 40 years ago into now 70, 80% service economy. That's what we do in the Western world. Now, to unwind that is an almighty
yeah,
change in economic policy. Okay? I just believe that the stabilisation of the equity market, the stabilisation of the bond market, is because you don't have to talk to too many insiders in America. And it's like, pass the message on, pass the message on. We will do what we have to do to sustain the American economy, bond market, and equity market. So it's a great, show being put on. Take on the world, force the world to change its trade arrangements. You saw what the markets did in reaction. Why have they recovered? Because those who need to know have been told, don't worry. Now, you might think I'm a complete nutcase for saying that, but there's so much evidence. We saw across Europe for a decade the printing of money. We saw interest rates in Germany go negative. We saw interest rates in Japan go to minus 1%. I don't know why people would think it's strange if America said, well, those guys did it for a decade. We're going to do it for the next decade and restructure the American economy as we do it. To me, it's logical. Okay? I don't understand it. I don't understand the ramifications of negative interest rates. But we cannot deny it has existed across the world for the last 10 and 20 years. And one aspect of what Trump and Besant are saying, if you listen to them in their commentary, and Besant's being in front of Congress in the last few days, and it'll bore you silly, and you'll see some very stupid comments made by congressmen, both sides, is that they're trying to rectify trade, and they are also focused on currency manipulation. Now, when you drive interest rates to negative, you are manipulating your currency down. Okay, that's what you're
yeah,
doing.
sure.
And that's an unfair trade advantage if you manipulate your currency down. So it's been talked about, but what I'm finding, and this is the strange thing, everything that Besant and Trump are complaining about in terms of unfair trade practices, they're going to adopt in an unfair trade practice for America through tariffs, manipulating interest rates, and probably pushing the US dollar down. So the hypocrisy is astounding, but let's just get on with it.
Yeah. All right, John, I think we well and truly run out of time, so we'll have to end it there. Lots of interesting and thought-provoking ideas. We'll come back next week and discuss these things.
See what happens.
Yeah, thank you.